Hi, everybody. Thank you so much for joining me. Before we get started, please hit subscribe to follow all of my latest investing and personal finance content. And be sure to check the link on your screen for a special message from our sponsor, The Motley Fool, where you can find the 10 best stocks to buy now. So, Tyler, it's been a very difficult couple of weeks in the real estate sector. A lot of REITs have just been slammed lately, and for a variety of reasons, depending on the sector. A lot of it has to do with rising interest rates. As soon as the Fed released their decision and it didn't decide to pause rate hikes, we saw REITs drop again. But one group of REITs in particular that's not doing very well in the past couple of weeks are the New York City REITs. The REITs like SL Green, Vornado, and Empire State Realty Trust that are really just concentrated in New York City have really underperformed. And I'll get into one reason that I've noticed is because a lot of their portfolios are very levered to the financial sector. And we've seen what's happened in banking the past couple of weeks. I know SL Green, one of their major tenants is Houlihan Lokey. So that's some exposure to the financial sector. Empire State, 20% of their rent comes from the financial sector. That's where the FDIC is headquartered, which is kind of neat in their New York headquarters. But First Republic is a bank that's really struggling to survive right now, and that's among their top 10 retail tenants, meaning the first couple floors of their building are all retail. They also have a lot of exposure to JP Morgan Chase, Bank of America, Santander, and a few other financials. But 20% financial exposures, I have to think that has something to do with the decline we're seeing in these. But I know you have some other reasons specifically in regards to financing.
Well, it's not just exposure to finance specifically, but just exposure to New York office real estate in general. If we kind of pull back and look at the occupancy of office real estate in the U.S., New York City is one of the lower occupancy rates overall compared to, a lot of places in the Sun Belt are seeing considerably better occupancy rates, just as whatever reasons you want to call them. Government policies, work from home policies based on corporate culture. However you want to cut it, I'm sure there's a lot of people that can have some political takes on that, but it's just the fact that the numbers are that we have lower occupancy ratings. And the longer those go on, after we're 3 years out of the 2020 pandemic crash, the longer that goes on, it's going to be harder and harder for companies to rationalize releasing a lot of these things. And so you have that as kind of the undercurrent. And then on top of that, you've seen with the rise in interest rates and the rise in cost of refinancing, you have a lot of these companies that made some acquisitions have some pretty significant development. Like, for example, Vornado is trying to do a big development right around, I believe it's right around Madison Square Garden there is kind of like the big metro hub in the area. So a lot of development costs or acquisition costs on top of that, where if you made them a couple of years ago and if you bought them at cap rates in the 5 to 6 range, now all of a sudden you're looking in the 8 to 10 range, your valuations are way down and your interest costs are going up pretty quick. And on leveraged assets like real estate, that can blow up your profitability very, very fast. We've already seen a lot of these. I was going to say, we've already seen Vornado and SL Green cut their dividends. And based on where, like, for example, Vornado, even after the dividend cut, they have a yield of 11%. The market's not buying. It's like, you're going to cut again.
Yeah, and I mean, the refinancing risk is a big problem, especially there's two kinds of financing that these REITs do, right? They can just kind of get a term loan or just, issue bonds or things like that. Or they can get property-specific mortgages. And a lot of these New York REITs use these property-specific mortgages. I know with Empire State, it's roughly half of their debt is property-specific mortgages. Those are what are going to be the toughest things to refinance. It's like if you bought a building for $100 million, borrowed $80 million to do it, and now that building's worth $50 million, you might have some trouble going to the bank and saying, I need to refinance this. Some of these REITs do have some cash on hand, but that's only going to do but so much.
Yeah, and it also depends on how long that's going to be. Let's say, for example, I don't have a major maturity due until 2026, 2027, then maybe I'll be okay, right? Maybe, maybe we're still in a high interest rate environment. Let's just say maybe slightly down, or let's go worst case scenario, we're still where we are today. If I've got 3 years to basically, fortress my balance sheet knowing I have to make that repayment, I'm gonna hide every stack of cash I can in couches and anywhere other than, other than uninsured bank deposits.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.